You are standing in front of a glass door with a hand-painted hours sign and a row of machines you can see from the sidewalk. The floor is linoleum. The light is fluorescent. There is a folding table bolted to the wall and a change machine that hums at a frequency you notice once and then stop noticing. Nothing about this storefront says opportunity. That is precisely the point. The people who built eight-figure holding companies out of laundromats did not start because the business looked exciting. They started because the math was quiet and the logic was durable and the competition was asleep. A laundromat is not glamorous. It is also not fragile. People need clean clothes in recessions. They need clean clothes when the market drops 14%. They need clean clothes on every ordinary Tuesday that the financial press ignores entirely. The business does not care about headlines. That is one of the most underrated things a business can be. Here is the actual model. A laundromat earns money through throughput and uptime. Throughput is how many cycles run per machine per day. Uptime is what percentage of your machines are functional and available at any given hour. Those two variables, not branding, not foot traffic campaigns, not a loyalty app, are the engine. A shop with 20 washers running 4 cycles each per day at $4 a cycle generates 320 on that day. Multiply that across 365 days and you are looking at $116,800 in gross revenue before dryers, vending, and any wash-dry-fold service you layer in. The numbers are not explosive. They are reliable. Reliable is harder to find than people admit. Neighborhood trust is the third variable and the one that does not appear in any machine specification sheet. A laundromat that is clean, well-lit, and consistently operational builds a quiet local reputation that compounds slowly and protects the business from every new competitor that opens with nicer tile and then fails to maintain the machines. Trust is earned in small moments. A working change machine at 11 at night. A floor that was mopped before the morning rush. A posted number that someone actually answers. These details are not accidents in the shops that survive. They are systems. Location selection is not intuition. It is arithmetic. You are looking for residential density without a strong competing shop within a quarter mile. You are looking for a neighborhood where a meaningful portion of residents are renters, because renters rarely own washing machines. You are looking at the lease terms with the same attention you give the equipment list, because a 10-year lease with favorable renewal options is an asset, and a short-term lease with an aggressive landlord is a liability that will not reveal itself until it is too late to exit cleanly. Visibility matters for walk-in volume. Parking matters in certain markets. The intersection of those factors narrows your target list considerably, which is the point. Discipline at the selection stage is cheaper than discipline after you have signed. When you are evaluating an existing shop versus building from scratch, you are solving a different equation each time. Building from scratch means you control the equipment selection and the lease negotiation and the layout, but you are buying a zero. There is no customer flow on day one, no operational history, no established pricing in the market. Buying an existing shop means you are paying for something that is already running. You are paying for the lease that someone else negotiated, the machines that have a maintenance history, and the customers who already walk through the door out of habit. That last item, the habit, is real economic value. It is also the item most buyers undervalue when they focus too hard on the equipment appraisal. The first operational system you build is not complicated, but it must be built deliberately. Pricing should reflect the local market and the machine capacity, not a guess. A maintenance cadence is a calendar, not a response to failure. Every machine gets inspected on a schedule. A list of parts that fail regularly is on hand before they fail. Cash control procedures exist on day one, not after the first discrepancy. How cash is counted, who counts it, when it is deposited, and how it is reconciled against machine cycle data are not administrative details. They are the structure that makes the business auditable and scalable. The unit economics at a single location are teachable. Revenue per machine per day, multiplied across the fleet, minus utilities, minus lease, minus any part-time labor, minus maintenance, gives you a number. A well-run shop with 20 washers and 20 dryers in the right location can generate $60,000 to $90,000 in net operating income annually. That is the range. Getting there requires occupancy above 80%, utilities managed against a benchmark, and a machine fleet that does not spend days out of service. The mistakes that quietly destroy returns in year one are rarely dramatic. They are deferred maintenance that compounds into a major repair. A lease with a rent escalation clause that was not modeled. Pricing set below market because the previous owner never raised it and neither did you. Labor that creeps above necessity because the system was never built to run light. None of these failures are loud. They arrive as margin erosion over 12 months until the number you expected and the number you have are separated by an amount that changes what the business is worth. That gap is where most first-time owners live. The ones who moved past it built systems before they needed them. That is the real first lesson. The first location is stable. Not celebrated, stable. The floor gets mopped on schedule. The machines run. The cash reconciles. The number at the end of the month lands inside the range you modeled. You do not throw a party, you build a document. That document is the playbook. It is not sophisticated at first. It is a list of what works, written down so that someone other than you can execute it without calling you at 9 p.m. on a Saturday. How the machines are cleaned and on what schedule. What a maintenance check looks like and who runs it. How a customer complaint gets handled, not ignored, not escalated to an argument, handled. What the floor should look like at open and what it should look like at close. The playbook exists for one reason. You are going to walk out of this building and hand the operation to someone else. Everything that lives only in your head is a liability the moment that transfer happens. Lightweight management is not an excuse to underinvest in people. It is a design decision. An attendant who knows the opening checklist, who has a contractor number to call for a machine that trips a fault code, and who understands that their job is measured by uptime and cleanliness, that attendant can run a location. They do not need a supervisor standing next to them. They need clear expectations and a simple accountability structure. Weekly check-ins, a 3-item report, machines down, complaints received, revenue logged against the prior week. That is enough to know what is happening without needing to be there. The moment that structure exists at your first location, you are holding a template. Margins improve not through gimmicks but through observation. Utilities are the line item most owners accept without interrogating. Hot water heating accounts for a significant share of operating cost in a laundromat. If your machine mix skews older, you are paying for inefficiency in every cycle. Upgrading to high-efficiency machines over time, not all at once, strategically, as older units age out, is not a renovation project. It is a margin recovery project. The same logic applies to dryer gas consumption and lighting. LED retrofit across a single location costs a few $100s and reduces an electricity line that runs every day of the year. Downtime reduction is invisible profit. A machine that runs 4 cycles per day instead of 3 because it is no longer waiting on a part you did not stock is revenue that the prior owner left on the table every single week. The second location does not get purchased with excitement. It gets purchased with a model. You are looking at a shop that throws off enough net operating income to support a loan payment and still clears a meaningful margin. Seller financing is more common in this industry than people assume. An owner who has run a single location for 2 decades and wants to exit is often willing to carry a portion of the purchase price if the alternative is waiting for a bank-qualified buyer. You offer a down payment, structured payments over 5 to 7 years, and you close faster than any institutional buyer would. The existing owner becomes a creditor with an interest in your success. That alignment is not nothing. Bank loans at this scale typically require 2 years of operating history, business tax returns, and a clean debt service coverage ratio. By the time you approach a bank for the second or third location, your first shop's financials are the collateral that the conversation is built on. Reinvested cash flow from the first location is also on the table. Not all of it. You maintain a reserve, a machine replacement fund, an operating cushion. But the excess, modeled carefully, becomes the equity contribution that makes the next deal workable. The hiring decision that matters most is not the first attendant. It is the first person who manages other people. That transition, from operator to manager, from the person who does the work to the person who runs the people who do the work, is where most small business expansions stall. You are looking for someone who tracks things without being asked. Who notices a problem on the floor before a customer does. Who can hold a standard without your presence enforcing it. That person exists in your attendant pool if you have been paying attention. They surfaced in small ways. They flagged the machine issue before it became a complaint. They asked about the supply order before the supplies ran out. You already know who it is. The question is whether you're willing to change their title and their compensation and let them carry actual accountability. That decision determines whether you run 2 locations or 12. Performance tracking across multiple shops is not a spreadsheet you check when something feels wrong. It is a dashboard you review on a fixed schedule so that something feeling wrong is never the first signal. Revenue per machine per day by location, machines out of service by duration. Utility cost as a percentage of gross revenue. Customer complaints per week. Downtime hours. These numbers, read together, tell you which location is drifting before the drift becomes damage. A shop whose machine downtime is trending up over 6 weeks is telling you something. A location whose utility percentage is running 2 points above the others is telling you something. The numbers are not the problem. The numbers are the warning. Reputation is the asset that does not appear on the balance sheet but governs the multiple when you eventually sell. A laundromat that has operated cleanly and consistently in its neighborhood for 7 years has something the competitor who opened last year cannot buy. Regulars who came in with their children and now come in alone. A community board that knows your name because you sponsored the local cleanup. A review profile that reflects years of ordinary reliability rather than a single good month. That reputation compounds the same way the financials do. Slowly, invisibly, until the day you try to sell or expand and discover that the number you command is not based on equipment value. It is based on what the neighborhood thinks of you and what they expect when they walk through that door. That expectation is earned one Tuesday at a time. There is no shortcut to it. There was never supposed to be. At some point, the model shifts. You are no longer looking for the next location. You are building the system that finds locations for you. That is the difference between a chain and an acquisition engine. One grows when you have time and energy, the other grows because you designed it to. Organic expansion has a ceiling. It is slow, and it is local, and it compounds your own blind spots. Every shop you build from scratch is a bet on a market you have not yet tested. Acquisitions compress that timeline and lower the uncertainty in a way that organic growth cannot replicate. You are buying a proven location with a real customer base and a real operating history. The market has already voted. Your job is to read the vote correctly and then improve on what the prior owner left behind. Speed matters here because the operators you are competing against for desirable locations are also watching the market. Every month you wait is a month someone else is having the same conversation with the same seller. Deal sourcing is a full-time discipline before it becomes a part-time one. Business brokers see volume, and you should be in their contact list, not as an occasional call but as a known buyer with a clear acquisition profile. A broker who knows you move quickly and close cleanly will bring you deals before they hit a listing site. That reputation is worth cultivating deliberately. But brokers see the same inventory every other buyer sees. The off-market channel is where the real edge lives. A targeted outreach program, letters, calls, in-person visits to laundromats in markets you are watching, surfaces owners who have not decided to sell yet but will. An owner who is 64 years old, whose kids are not interested in the business, whose equipment is aging, and who has never heard of a professional buyer reaching out personally, that conversation opens doors that no broker intermediates. Referral networks matter too. Your equipment vendors know who is struggling with maintenance costs. Your accountant knows which operators are having conversations about exit timing. Build the network deliberately and the deal flow changes character. Due diligence is where the acquisition engine either earns its money or bleeds it. The number that matters most in a laundromat acquisition is not the revenue. It is the verified revenue. Utility bills tell you actual usage. Water consumption per month, gas consumed per billing cycle. You cross-reference those numbers against the claimed wash counts and the claimed revenue. They either corroborate each other or they don't. If they don't, you ask why. Equipment age is not a line item, it is a replacement schedule. A shop with 8 top-load washers that are 11 years old is not a stable business. It is a machine replacement project that has not been priced into the purchase. You build that cost into your offer. Lease risk is the variable that destroys more acquisitions than equipment ever will. A shop with 3 years remaining on its lease and no renewal option is not a business. It is a temporary cash flow sitting on borrowed time. You want 10 years of term or a clear path to it before you close. Real customer counts, not claimed ones, come from utilities, from point-of-sale data if it exists, from observing traffic patterns at the location across different days and times before you make an offer. Owners misremember. Numbers do not. Value creation begins the moment you have the keys, not the moment the business is comfortable. Retooling layouts eliminates friction in the customer experience that the prior owner stopped noticing years ago. Machine placement, folding space, change machine positioning, sight lines from the entrance. Small adjustments compound into throughput. Pricing discipline is where most acquired shops have been managed by inertia. An operator who set prices in 2017 and has not revisited them because the regulars seemed comfortable has left margin on the table every single year since. You run the utility cost per cycle and you set prices that reflect the actual cost of the service. Customers who have been using a shop for years do not leave because the wash price moved from 3.0 to 3.75. They leave because the machines do not work. Vendor renegotiation after acquisition is not aggressive. It is standard. You are now a multi-location buyer. The chemical supplier, the parts distributor, the linen service if you have added one, all of them are looking at a larger relationship than the prior owner represented. You price that accordingly. The back office does not scale at the same rate as the locations unless you design it that way. Bookkeeping centralized across all locations, not managed separately at each shop, gives you consolidated financials that are auditable and comparable. Maintenance dispatched through a single coordinator, not through individual attendants calling whoever they know, means faster response times and a vendor relationship that gets better with volume. Purchasing consolidated across locations gives you leverage. Reporting standardized across every shop means the dashboard you built for 2 locations still works at 8. The back office is infrastructure. It is invisible when it functions and catastrophic when it does not. Capital structure at this stage is not about growth velocity. It is about durability. Debt service coverage ratios below 1.3 are a compressed margin that one bad month can breach. Covenants from lenders deserve attention before closing, not after. Reserves are not optional. A portfolio of 8 locations needs a capital reserve that covers equipment failure, a lease negotiation that extends longer than expected, and a manager departure at the wrong moment. Overleverage is the failure mode that ends otherwise competent operators. The businesses are boring. The balance sheet discipline has to match. The platform emerges when the laundromat infrastructure starts supporting adjacent services. Dry cleaning drop-off, commercial linen contracts with hotels, salons, small restaurants. A wash and fold service priced for the customer who values time over cost. Each of these has a lower customer acquisition cost than building a standalone business because the foot traffic and the trust already exist. The laundromat is the distribution point for the adjacent revenue. The adjacent revenue is not a distraction from the core. It is the core business extended through the same 4 walls you already operate. You do not announce any of this, you build it quietly. The Tuesday after closing still comes, you run the numbers. You fix what is drifting. You expand what is working. At a certain point, the business stops being a business and starts being a structure. You do not feel the transition when it happens. You recognize it afterward, usually during a conversation with an attorney or a lender who starts using words like governance and entity consolidation and operating agreement amendments. You file those words, then you build what they describe. The HoldCo is not a rebrand. It is a legal and operational architecture that separates the assets from each other and from you personally. Each location sits inside its own entity. The entities sit beneath a parent. The parent holds the equity, controls the capital allocation, and is the entity that a future buyer, a minority investor, or a recapitalization partner looks at when they want to understand what they are dealing with. Building that structure early costs more than most early operators want to spend on legal fees. Building it late costs more than that. Governance at scale means decisions have owners. Not you. Not whoever is closest to the problem. Specific, named owners with documented authority. An operating CEO or general manager running the day-to-day portfolio while you run the capital side is not a luxury at 8 or 10 locations. It is the only way the math works. You cannot be the operator and the allocator simultaneously without one of those functions degrading. The person running operations needs authority to hire, fire, spend within defined budgets, and make maintenance decisions without a phone call to you. That authority has to be real or the title is decoration. Internal controls mean the cash reconciliation does not depend on trust. It depends on a system. Camera coverage at change machines, point-of-sale records cross-referenced against utility data, bank deposits verified against reported receipts. The controls are not surveillance of people you distrust. They are the infrastructure that makes trust verifiable. At scale, the difference matters. Portfolio strategy is a capital allocation question dressed in operational clothing. More laundromats are the obvious answer until they are not. A mature portfolio in a market approaches saturation. The incremental location produces lower returns than the first one did because the management attention is thinner and the geographic density is optimized. At that point, you ask whether the next dollar goes into another laundromat or into the next category of boring. Self-storage, car washes, small commercial laundry contracts. Vending route consolidations. The criteria are the same as the first laundromat. Low customer concentration, non-discretionary demand, durable margins, simple operations that do not require your daily presence. The HoldCo structure is the container. The portfolio inside it can expand into adjacent categories without restructuring everything you have built. Capital allocation has 4 destinations and only 4. You reinvest in the existing portfolio, improving equipment, expanding locations, adding adjacent revenue. You acquire new assets. You pay down debt to reduce coverage risk and create future borrowing capacity. Or you hold liquidity as a reserve against the variable you have not modeled yet. Most operators default to acquisition because acquisition feels like progress. The discipline is knowing which of the 4 uses produces the highest risk-adjusted return at a given moment. When debt service coverage is tight, paying down debt is not conservative. It is the highest return available move. When the portfolio is healthy and a compelling acquisition is available, deploying the reserve is not reckless. It is correct. The rules matter because emotion makes all 4 options feel equal and they are not. Risk at this scale is not one thing. Concentration in a single metro means a zoning change, a flood event, or a commercial real estate correction affects your entire portfolio simultaneously. Geographic diversification across 2 or 3 markets is not complexity for its own sake. It is a hedge against correlated downside. Regulatory shifts around water rates, utility pricing, or commercial lease protections happen slowly and then quickly. You track them before they land, not after. Insurance coverage at the holdco level needs to reflect the actual replacement value of the portfolio, not the original purchase prices. Cyber and cash controls sound abstract until a manager figures out a reconciliation gap that nobody designed a system to catch. The boring businesses generate cash, and cash that moves through the same hands every day without structural oversight finds ways to disappear. Exit options are not a capitulation. They are the range of outcomes that competent ownership produces. A recapitalization brings in a minority partner who provides liquidity and validation without requiring a full sale. You extract capital while retaining control and continuing to compound. A minority sale to a search fund, a family office, or a regional private equity firm with a buy and hold orientation is a different transaction than a full exit, and often a better one at this stage. Long-term ownership with a professional management layer in place produces compounding that a one-time sale cannot replicate. The optionality itself has value. You do not have to choose. You have to stay ready for each option, which means the financials are clean, the documentation is complete, and the management does not depend on you to function. The culture of a boring empire is not exciting to describe. Maintenance schedules followed without exception. Metrics reviewed weekly without ceremony. Equipment replaced before failure rather than after. Managers measured against numbers they helped set. Problems escalated early rather than managed quietly until they cannot be. The boredom is the feature. Every operator who chased complexity in the back half of their growth curve produced a business that was interesting to talk about and difficult to run. The ones still operating at scale after 20 years are boring in exactly the same way they were boring at the beginning. They just have more locations, a cleaner balance sheet, and a calendar with fewer emergencies on it. That is the whole arc. One machine, one location, a system that compounds the same logic across more assets, more categories, more years. Pick one metric this week: revenue per machine, utility cost per cycle, debt service coverage. One number you do not currently track at the frequency it deserves. Build the habit of watching it. The empire, if it comes, grows from that. Subscribe if you want the next breakdown. The models stay boring. The results do not have to.